Hello and welcome to BQ Prime. You're watching Earnings with BQ, and my guest today is Satish Pai, MD and CEO of Hindalco. Mr. Pai, thank you very much for joining us on BQ Prime, and season's greeting to you. My first question to you is on the demand scenario, both in the domestic market and in the international market. How do you think demand is faring in both? Because there is a dichotomy with respect to the growth rates which we are seeing in both the markets.
So let me start by India. I think that in India, both the aluminium and copper demand is extremely strong. Aluminium is growing at 10%, copper is growing at 7, and it's largely driven by electrification, building and construction, and auto. So domestic demand for metal is extremely strong. Now, if we go internationally and look at the sectors that we play in, the can demand, as after the destocking exercise has started to slowly stabilize and pick up. Auto demand has always been very strong for us, double-digit growth, largely driven by electric vehicles. And if you look at aerospace demand is very strong. The demand for planes is strong. The only weak sector has been building and construction. So largely that is in the US market because of higher interest rates. The housing market is a little bit depressed. So that's the one sector which has started to stabilize, but still year on year is down.
Mhm. Uh, if that's a demand scenario, how is the pricing scenario there? Because we've been seeing some kind of softness in aluminum prices and some bit in copper as well. How do you see pricing going forward, especially in the second half of the year?
Yeah, I think that, aluminum and copper prices are range bound, and I think they will continue to be range bound largely because of macroeconomic uncertainties. I mean, people are getting comfortable that the US economy is going to be fine, that the Chinese economy is showing signs again. But there is another war that has broken out. People are worried about whether it will spread and the impact. So I think largely because of macroeconomic uncertainties, commodity prices are range bound and a little bit depressed.
Mm-hmm. Realizations, EBITDA per ton, you did have a good EBITDA per ton, 9% jump to 751. Do you see this sustaining, given the kind of some of the challenges that you mentioned, or the demand scenario is such that you can see you can build upon this kind of EBITDA per ton?
No, what we have planned is that in Q3, the LME will be at the same levels as Q2. And we are expecting costs to remain flat. So yes, we are expecting that in Q3, our EBITDA per ton and the margins will remain at the same levels as Q2.
Mm-hmm. How do you bring in the China angle here? Demand from China and the production and consumption have been fairly flattish. We haven't seen on a sequential basis much of growth coming in there. Do you see China demand to pick up in the second half of the year, as some people are predicting that China is opening up and there is some demand coming in now?
I think we can already see signs of Chinese economy and demand starting to pick up.
Mm-hmm.
Actually, I'm very happy if it does because I'm very worried about sometimes the dumping of Chinese foil and rolled products that happens in India. So yes, we are expecting that their economy and demand will pick up, and then hopefully the imports into India will go down.
But will that have an impact on the pricing as well?
Not really. I mean, the LME prices, as I said, are driven by more macroeconomic environment things
Mm-hmm.
right now. And it's not, I think that if the Chinese demand picks up, then LME may go to the higher side of the band. But for it to break out of the band, it's going to need macroeconomic risks to be more, mitigated.
Mhm. On the novelist front, we saw EBITDA coming down a bit there. Why is that? Means even your shipments have fallen by 5.2% to 933 kilotons.
No, so sequentially, our shipments have gone up by 6%. And actually, the EBITDA per ton now has gone back to $519 per ton. So I
Hmm.
think on a year-on-year basis, they look low because we went through a downturn with the destocking of Q3 last year. It
Hmm.
started to come back Q4, Q1. And actually, we are very happy with the Novelis performance because it's going as how we predicted with the can demand coming back. We are now back to over the $500 per ton EBITDA.
Okay. And also, you're taking an aggressive expansion plan there for Novelis, $3.5 billion of expansion coming in there.
Yeah.
How do you see that panning out? Will you be doing the entire expansion or capex through internal accruals, or will there be an increase in debt? Because
No,
in
there
the
will
last
be
couple
no.
of quarter, you have reduced your gross debt,
Yes.
but on the net level, it's gone up because I think the cash utilization has
Yeah.
gone up.
No, but if you look at it, you have to break it up between Novelis and India. In India, the debt continues to fall. In fact, the gross debt is now only about 10,143 crores, and the net debt is 1,000 crores. And we are at some 0.13 net debt to EBITDA. On the Novelis side, the net debt to EBITDA is at 2.7 because their EBITDA had gone down, which is starting to come up. But the first question is all the capex will be through internal accruals. And as the EBITDA has now started to pick up, you will start to see the net debt to EBITDA of Novelis also start to come down.
By when do you expect this capex to be completed?
It's going to take at least another 2 to 3 years because these are large capex programs that we have announced.
You're also undertaking $1.5 billion, $1.13 billion in India, and
Yes.
then today you have announced another 8,000 crores for aluminum refinery and a captive power plant. How do you plan to go through that, and what is the timeline for that?
So look, we announced the alumina refinery, as you said, it's a 8,000 crore project, but it's in two phases. Currently, we are doing the Sambalpur expansion project of 3,500 crores. So we think that we are going to be spending anywhere between 4 and 5,000 crores every year going forward. And we will do these projects largely with the cash flow that we have generated.
You are sitting on a comfortable net debt as far as India is concerned. Will India be also completely driven by internal accruals, or there may be some kind of gross debt that need to be taken for that?
Right now, we are going to be still driven mostly by what our internal accruals are. The projects
Mm-hmm.
that we see, we are comfortably being able to manage it with the cash that we generate.
Mm-hmm. Uh, you know, I was looking at your presentation. You were projecting a domestic demand growth of 7 to 8% in FY24. Uh, are you hopeful of this 7 to 8% demand growth? Means what can this be accelerated further? Means as the economy picks up, or is this a conservative estimate from your end?
No, that's a yearly number because Q1 was not that great, but Q2 grew at 10%. And I think Q3 with the holiday season is also going to be strong. So I think that, if anything, those numbers actually can be better.
Mhm. Uh, so you're saying that on an consolidated financial year basis, 7 to 8% is something which you're looking at. What
Yes.
about internationally? What is the kind of growth rate that you're looking there for
So look,
FY24?
yeah, but there I think you have to go sector by sector because
Yeah,
on the can
but
side we see a
yeah.
3%, auto we are seeing 11 to 12%, aerospace is also strong double-digit growth, and building and construction, as I said, is little down versus last year. Hopefully next year will be flat versus this year.
Uh, means you said that destocking is over, but you're still pegging the can shipments at around 3% odd. So I was thinking that do you still see some bit of slowness in terms of demand picking up in that sector?
It's not slowness in demand picking up. I think that some places like Europe and Asia, the economic growth is not that great. So then the
Mm-hmm.
can demand will not be very strong. Whereas in US, the demand has come back, the economy is picking up. So if you balance that all out, we are picking 3% for a worldwide number. But there are some regions where it will be stronger, some regions where it will be a little bit weaker.
S- Mr. Pai, for the domestic business at least, what is the kind of EBITDA per ton that you see would be the level that you end or exit FY24 with?
We are going to see this at what current levels are, roughly 700 to $750 per ton on the
That
aluminium
would
side.
that would be the full year one for you as well. Means you're
Yes,
looking at.
yes.
And one sector which I wanted to ask you about is Indian Railways, because you had tied up with some of the players as well. How big is an opportunity for that? What will be your role in that?
So look, we see that the Indian Railways, whether it is the rake and the bulk volume side, or whether it's the passenger bogies, both as a huge market for us. So we are playing on both sides. We are watching closely the 100 aluminium trains order that has just been announced by the Indian Railways. And we are planning a large capex project to put up a big extrusion plant to make those bogie bodies in India. So we will be investing to take advantage because we think that as the speeds go up, I mean, when you go above 150 kilometers per hour, the train bodies have to be aluminum. That's what it is everywhere else in the world. So we see that as a huge market opportunity for us.
What is the kind of investment that you envisage for such a thing, and will you go solo for as far as investment is concerned,
Yeah,
or
yeah. We will do it on our own. We see, the big extrusion press is about a 2,500 crore project. We are already looking for land to put that press up.
and you're looking at in Orissa only, or are you looking at?
I will tell, I think when it's clearer when we get the land, I'll tell.
But you see this as a big opportunity for you and other players, because as Indian Railways also transform itself to be much more faster and high
Correct.
speed, this is going to be a big player, big division, something like a aerospace and kind of thing.
Yes, yes.
Mr. Pai, it was a pleasure talking to you today. Thank you very much for joining us on BQ Prime.